Welcome. We are here on Real Estate in the Lowcountry, and joining me is Matthew Dailey, and he is from Assurance Financial, and we're going to talk about things from the buyer's perspective today. Welcome back. It's nice to see you again.
Hey, Betsy. Good afternoon. How are you?
I'm well. How are you?
Good. So we're going to chat a little bit about what we need to do to get ready to buy a home.
Yeah.
Okay? So, when do you start? We recommend you start, 3 to 6 months prior to that time.
Okay.
And really from a financial standpoint, there's 3 things that you need to take in consideration: your credit profile, your source of income, and third, your assets or down payment.
Let's talk a little bit about the credit part of it, because you're saying, to give yourself a lead time of 3 to 6 months. If there is something that's on there, or there's, your score maybe not where it should be, is there something within those 3 to 6 months they can do to maybe boost it a point or two?
Absolutely. That's a great question. And that's why we recommend talking to us, further in advance.
Right.
Is so we can take a look. Sometimes people are hesitant about having their credit checked. You can monitor it yourself, or you can speak to a loan professional like myself. We'll take a look, and we often can find where you can increase your scores by paying off some existing credit card debt. There may be some things on your credit that you're not aware of. So that's why we really suggest, taking a look at it 3 to 6 months in advance.
Yeah, and to that point too, you also, in those 3 to 6 months, don't want to make any other big purchases, like a car or, maybe a renovation of your home or anything like that that's going to show that you might not have as much money as they thought you may have.
Exactly, Betsy. You want your credit to be consistent. You don't want to have any additional inquiries on your credit, and you don't want to change what your debt-to-income ratios could look like once you speak to a lender and get the process going.
And so when they're getting ready to talk to you within that 3 to 6 month time frame, and you are talking about assets and income to debt ratio, things like that, what is it that they should keep in mind if they say, that they're looking at, okay, I have this amount of income, what is that going to mean to me and what I can actually afford when I'm buying a house?
Sure. When we talk about income, we look for 2 years history. We like consistency with your employment or your source of income. We can work through a job change. That often happens.
Yeah.
Typically you're in the same line of work, but if not, we can still work through it. The key there is having consistent employment and sharing that information with your lender.
And then let's talk about being pre-qualified, because that's really important, and particularly in this market, sellers are going to really want to see that, because I know things are changing because we've had interest rates go up and the markets are maybe a little softer than it was. But if you are still in a seller's market, they're going to want you pre-qualified
Right. Actually, pre-approved is still the desirable person that's out there competing for an offer. And really, what that means is you've provided the lender your W-2s for the last 2 years, your pay stubs, your bank statement showing the source of down payment. Not only have you filled out an application, but you've provided additional proof. So your offer is given more consideration than somebody's just pre-qualified, meaning that you filled out an application but not provided the additional documentation.
Gotcha. Okay. Very, very good distinction there. I didn't really realize that was such a big distinction. So in that 3 to 6 month time frame, when does somebody want to get pre-approved?
If you're thinking that you're going to buy a house in the next 6 months, today's a good day to get started.
Okay.
Because that gives us time to navigate through things and put you in a better position. You mentioned credit profile. If we can move you 20 to 30 points,
right.
You may save $40 or $50 a month. And over the term of the loan, now we're talking $25,000 to $50,000, depending on your purchase price.
Yeah.
So it's a big deal.
It is. It's a very big number. And let's touch, in our last minute here or so about the fact that interest rates have gone up, and maybe people are a little bit, gun shy, not knowing what's going to happen. Talk them through that process where it's still okay and there's still some options.
Sure.
For them.
The market has changed. The cost has went up. But what I tell people every day, you're going to marry the house and you're going to date the rate. Okay, we can refinance 18 months from now.
Yeah.
Find the house you love, buy that house, then let's work through 12, 24 months. We'll lower that. We can refinance and get you into a lower payment.
I love that. We're going to leave it on that note. Marry the house and date the rate. I think that's fantastic.
Right.
We need to put that on a t-shirt or something.
Right.
I think that's great. Thank you, Matthew, for being here. Great information as always.
Thanks.